Traders, Cousin Vinny coming to you from theclosingprint.com on February the 9th, 2020. In this edition of your weekend video newsletter, we'll talk about the strength in the markets, where we might be seeing weakness, and the performance of all of the FANG and leading tech stocks last week and how we might trade it as we trade near all-time highs. The bond stock ratio turned back up, a bullish reversal. The longer-term trend is still very bullish. Dow Composite, we saw a bounce, and the S&P 1500 is bullish. XII, the ARCA Institutional Index, a measure of what institutions are doing, very important, is also moving higher. It gave us a bullish signal and appears to be back in its bullish trend. Tick and TickQ did rise a bit last week. We got a green signal. It's oscillating a little bit towards the end of the week. We'll watch that to start the week. NYMO and NAMO are at the bottom of bearish cycles trying to turn higher. We also saw breadth thrusts almost hit minus 30 last week and turn back up. We'll discuss that in a minute. NYHL is in a bullish cycle. It's still above the zero line and rising. It's a bit conflicting with other things we're watching. So if you look at the bottom of this opening monologue list, you'll see that we're cautiously bullish or neutral. That's because we have a lot of signals that are either opposite each other, conflicting, or sending mixed signals. For example, US dollar is breaking out. That's moving higher. That could be a caveat or a problem for equity bulls in the short term as we trade near all-time highs and a double top on the S&P 500. The heat map also started to improve last week. We saw a major change in the spider sectors. We also see improvement in the international market, so that's something we need to pay attention to. We'll look at some IBD 50 names, some Market Smith Growth 250 showing relative strength, and stocks that are showing up on the above average volume scan in green. Bukowski has 505 green with his CPI signal, another conflicting indicator, moving from 16.7% to 21.9%. That's still bearish, but improving, with 25 bearish patterns, 7 bullish patterns, and 334 patterns waiting for a breakout. Again, bottom line, we're cautiously bullish. We're waiting for institutions to give us signals that we can start to swing again. Until then, we're still in day trader mode. So that means we'll take stocks in the morning, assuming that we're going to exit by the end of the day. Stocks that close at the high of the day, we might consider taking half off and leave the other half on for potential gains. Here are the spiders for the week. Do note that we see some divergences like we did back here in late November, early December, that eventually resolved to the upside, having broken out of this base and went on to a nice 17 to 18% gain depending on your entry. And what I've noticed is what we pointed out previously, that there's been many occasions where the markets have consolidated recent gains in time. There's no guarantee that price action will pull back dramatically. We could also just stay right up here and frustrate both the bulls and the bears. If we do pull back, we did take some strangle puts last week. At the end of the week, we took some 329 puts just in case we test the 9 EMA. We also have some 334 calls in case we break out. The puts are more out of the money, so they're less expensive, so I have twice as many puts as I have calls. Bottom line, we do have a MACD cross. We were looking for that last week. We finally got it. If we do continue higher, it'll be a function of price. RSI is above 50 like it was back in November, December when the markets did fail briefly, but then broke out. Catalysts, of course, on the bearish side are the coronavirus and fear. Maybe people are trading less, which is a good idea, actually. We've talked about that quite a bit. Trading smaller with a day trade mode mentality rather than a swing trade makes sense. Longer term accounts, retirement, whatever. We haven't changed any of our positions in our long-term accounts. That said, we need to pay attention to what institutions are doing. Are they buying or are they selling? Last week And the week before, we told you we saw potential for red sticks. That was a sell signal. Once these red sticks dissipated and we started to see blue and green, that gave us the potential to buy some stocks at a discount as institutions were back at it again, buying the markets. We're back above the 21-day. We're also inside of standard deviation 1 and 2. We have green sticks. We're above this recent high, which now is support. And we have momentum indicators, mostly bullish, with a little fade on Friday. So the takeaway is institutions are buying. We want to ride their coattails. In addition, broader measures of market participation like the S&P 1500, S&P 500, S&P 400, mid caps, S&P 600 small caps is still on a bullish signal. It is starting to waver a little bit. And if we break down breadth in all three, S&P 500 in the top, S&P small cap 600 at the bottom, we can see a lower high in each case. And if we do continue to move a bit lower, that's telling you to be more cautious, risk off, if you will. If we lose the 21-day and continue lower, there's always a possibility we could bounce in this area if we do pull back, and the 200-period EMA is just below that. MACD is trying to cross, and volume has been increasing. An even broader measure of market participation would be the Wilshire 5000. We are pulling back from a double top all-time highs condition. RSI remains above 50, so we have to respect the trend, which is bullish, though we might pull back a little bit more to the 21-day. That said, the cycle is starting to bottom just below the zero line. There is always a potential that this could roll over and move lower. That would be a good opportunity, or it could continue to move higher this week if we see investors picking up shares instead of selling. This is another chart that is more neutral in the short term while still being in a bullish trend. The S&P 500 equal weight index is also bullish. It did pull back a little bit. We got a trigger last week, which faded somewhat on Thursday, Friday. So we're looking for a follow-through at this point. As previous verticals and triggers had indicated, the markets didn't go straight up. There were periods where price action did flag at the 200-period EMA over here in summer of 2019. We also saw this little pullback in September, October, finally bouncing, got another signal at that point, followed through, flagged, followed through, flagged. I think you get the point. So we're not going to go straight up or straight down. We're going to back and fill along the way. The trend is up presently, though the markets seem to be somewhat overbought. You can see that we did make a new high, which is something of a divergence. That's telling us that the stocks that are heavier weights on the S&P 500 are controlling the price action to get above highs. So that's another consideration and the reason why we're cautiously bullish this week. The NASDAQ 100 index, 100 stocks in the technology, biotech, and associated groups, created a very bullish candle last week, closed in the upper half of its weekly range. RSI is showing muscle. Literally, it looks like a bicep in profile. This can stay embedded. This is a bound indicator, so it can only go from 0 to 100. I don't recall the last time I saw it at 100, but you get the point. It's above 70. You can stay up here. It just tells you there's a very strong trend when this is occurring. While the NASDAQ composite of over 3,000 stocks did move higher last week, we had, again, divergence on RSI, but it looks pretty strong. I wouldn't be surprised to see a little pullback into last week's range to start the week, so we'll plan for that. As prices did move higher on above average volume and MACD's above its signal line, it would be hard for the bulls to just completely give up at this point. While price action did make new highs, we saw the number of stocks above their 50-period moving average dissipate a little bit. While there are two ways to look at this, we could also see that once we get into the red zone, almost all stocks are above their 50-period moving average. When we pull back, that could show a lack of strength for bullish continuation. It can also show that stocks are pulling back and taking a breather. There's nothing that says that price action needs to drop dramatically. We can consolidate in time, as we said previously with the S&P. Therefore, If prices start to move higher, we're not at an extreme condition and can continue to move higher. The flip side of that, of course, if this continues to move lower, that's telling us there's fewer and fewer stocks participating and staying above the 50-period moving average. So there's underlying selling that we need to pay attention to in the latter case. Here is the Dow Jones Composite. This looks pretty neutral as well. Looks like a range. We could come back down to these lows, consolidation area that we saw back in December and January, and then bounce. Or we could just break out, consolidate in time. So we need to keep an eye on these 65 stocks from the industrials, transports, and utilities group in the short term. We also see the New York Stock Exchange Composite, NYA, removing candle prices so that we're not biased by looking at candles. We can see the 50 period is moving away from the 200 period. Both are upsloping and bullish. MACD is dissipating somewhat, so the takeaway is we need to be cautious at the present time as momentum is slowing. And breaking down the stocks therein, we can see participation is still mostly bullish. We're above the zero line, the moving average, while bouncing last week did fade a bit on Friday. We do have green elder sticks, but we're not at all-time highs like we were on the S&P 500 or the NASDAQ 100. So there's still potential for this to continue climbing. There's also equal probability that we could pull back. No sell signals until we see red bars down below the zero line, like we had back here in late July and again in September. So this doesn't look like these two indications over here. Looks more like we could see a bounce. So rather than speculate on what might happen like CNBC does every day, we want to see what does happen. Right now the cycle is at a low. I'm looking at the black line in the upper panel. We're at a cycle low. It's tilted a bit lower on Friday, as you can see with this stick from the New York Stock Exchange. Still green, but gapping down on Friday. After gapping up Tuesday, Wednesday, Thursday, we're looking for this to turn back up. So until we see an obvious turn like we've had in the past, we see this little double dip here as well. Back in August, similar to what we might be seeing right now, except in a shorter duration. Still oversold, looking for this cycle to turn back up, as this will give us an indication that it could last, in this case, more than 14 trading days before moving sideways. And back here, 35 days once this cycle turned up. So watch the cycle. It'll give us an indication that we might see a few weeks of upside going into what is the seasonally strongest months of the year. As we can see, February over the last 10 years did move higher in February, took a little breather in March, and then finally the strongest month of the year over the last 10 years was April. So we have something to look forward to if we just consider seasonality. All things considered, VIX did pull back, as we mentioned in last weekend's video, that a touch in the green zone or a push into the green zone usually dissipates within the next few days. That's a fade the fear moment. You buy SPY calls or start to trade a little bit more to the long side. Can we push back up and really spike higher? That would be an indication that there's some fear out there other than, or maybe in addition to, more coronavirus victims. That could spike us up to the highs. If that were to happen, that would be another situation where we could get long and fade the fear again. Of course, in the present, we took SPY puts just in case this does spike higher and we do get a pullback instead of a consolidation in time. The bond stock ratio is also long-term bullish, turning over like it did back here in late 2016 into early 2017. The indicator does have a potential to move up and down on a shorter time frame, but for the longer term trend, we can see that this is beginning to be more bullish as this starts to drop and the ratio continues lower. That's telling you that equities are favored over bonds. And since institutions run the markets, we want to keep an eye on XII, which we previously covered, for signs of whether they're buying or selling. Presently they're buying, and this indicator is confirming by moving lower. We also saw TLT pull back a little bit last week, having driven higher 2 weeks and 3 weeks ago. breaking out of this descending channel pattern on the announcement of the coronavirus. The safety trade was on, and buyers of TLT pushed prices back up near highs. Right now it looks like we're starting to consolidate. Anyone who wanted bond exposure did so over the last 3 weeks. This is AGG, the Barclays Aggregate Bond Fund. This is what bond traders use as their benchmark, just like equity traders use the S&P 500 and the Dow Jones, if you're CNBC, as their benchmark. We did push higher over the last 3 weeks. Anyone who wanted bond exposure added along the way or started new positions as we broke out above that 112.90 zone, give or take. We do have a position in this in our retirement account. We haven't changed our exposure since this last flag breakout when we sold into strength. We do have about 45% exposure in our retirement account in fixed assets, bonds, etc., and similar type assets. The other 45% is in equities, international markets, and U.S. domestic, and we have 10% in real estate and some cash positions. That said, MACD is crossing. We're watching how price action reacts this week. If it does move higher, that's telling you that investors are continuing to seek safety in bonds, gold, and other safety type assets. On the other hand, if you look at risk assets like junk bonds, where traders are willing to chase yields higher, seeking out higher yields because the Fed is dropping rates, we can see that this pushed higher, and it's another risk on, risk off indicator. Pushing higher is bullish for equities. We can see a consolidation very similar to price action on the S&P 500 and the NASDAQ last week, gapping up Tuesday, Wednesday, and Thursday, and consolidating Friday. Nothing says that we have to pull back. We could consolidate in time. We also want to pay attention to currencies. The British pound US dollar pair is moving lower. As it does, the London Stock Exchange is moving higher, which we pointed out yesterday on StockTwits and on the stream. We came back to the weekly 21 period moving average. We rose again as the British pound US dollar pair continued to move lower. We broke out of this flag and started trending again and making new highs. So if you're trading the London Stock Exchange, the FTSE, or any assets in the UK, you should be open to the possibility that this is going to continue to move higher, occasionally testing the rising 9 EMA in this case. Always keeping in mind there are other places to put your money besides US assets. So if the London Stock Exchange moves higher when their currency moves lower, you would reason that it's possible with the US dollar moving higher that US equities might pull back. So there's always that potential. Keep an eye on the US dollar. It was in a very bullish trend over the last few weeks, bouncing off of this lower trend line, passing right back through all of the moving average, the 21, the 50, and the 200 period, on its way back up to what could be a very nice triple top, double top situation with RSI rising. If that happens, you would expect to see dollar-based commodities like copper, gold, crude, etc. bouncing as well. We did see that in copper. If you're bullish US equities, you want to watch this forward-looking indicator. We want copper to get back up to the highs, similar to what we saw back in 2009. This forward-looking indicator bounced 4 months prior to the reversal, March 9th, 2009, when the equity market reversed and started moving higher, starting this 10-year, 11-year-long bull market. Again, after the U.S. elections for president, 2016, this started moving higher over the next couple of years. We've since tapered off somewhat, been consolidating in a descending channel, which could break to the upside. We want to keep an eye on copper, especially if you're trading anything in the builder group, construction, or building products. Keep an eye on copper. Copper bullish would be bullish for those particular stocks. Gold as well has been in a bullish trend after breaking out of this descending channel that we pointed out back in December. We finally got the follow through. We got above this area of volume by price, trading in an area where there's literally no one up here, no supply. We tested the highs. We thought we might see a test. In this case, we saw a lower high. Price pulled back. This is probably because institutions and other traders are taking profits a second opportunity. If we don't get back above these highs, consider this an area where they started selling and look for more downside in the short term. And finally, we see the same thing over the last 5 weeks. Crude oil did drop precipitously, over 23.5% before reversing at the end of the week. Volume increased dramatically. So we're either going to bounce back up into this range or lose it. If we lose it, that would be another bearish caveat for equity bulls and something that could pull the equity markets lower off of its all-time highs. Here is the sector heat map. We can see a very dramatic change from crimson to yellows, lime greens, and green. International markets also dramatic improvement over the last couple of weeks, changing from crimson to yellows and limes. Very few reds now at this point. Just pause the video and take a look at some of the areas where we've got weakness, like Greece, in addition to the bounce we saw in China-related assets last week. The same goes for the IBD 50 stocks. We want to pay attention to the ones that are trading above a bullish 21-day, a bullish 50-day moving average. Price action maybe recently testing the 21-day like we see with Google and presenting an opportunity for a breakout. We saw Amazon break out of a very large range that took several months to form. Most likely going to see a follow-through on Amazon this week. Also see people talking about BlackRock. This is one that Robert traded early in the room last week. He got long the calls. He did very well. He's on vacation this week, but looks very good in a nice bullish trend. I love stocks that look like this. Very nice uniform price action. When it breaks out and it continues trending, you have very good opportunities for buying at the 21-day. On test and then follow through, a test, follow through, RSI is above 50. When these conditions are met, your probabilities of success are much greater. RSI above 50, price above the 9 and 21-day, look for tests of the 21-day. Your entry is the day after a test or the day of if it's a reversal and it's very strong. Then look for MACD to be rising as well, volume to be increasing. If you have positive R-ball relative volume, you've got a pretty good trade setup and a higher probability of success. And Mikey was talking about it back here when it crossed over the 200-period moving average and it broke out above this trend at $450 per share. We also see stocks like Adobe trending higher, a little base at the 9 EMA, broke out, consolidating right now, showing RSI muscle, moving higher on above average volume, MACD above its signal line. I'm looking for a little pullback to the 9 EMA. If that gets bought like it did back here, it might be a good entry and look for higher prices in the short term. AMD is also new on the IBD 50. I took some calls last week, an early entry, looking for the 21-day to hold. I have a stop below the 21-day. If this continues to move higher and breaks out, I'll have an opportunity to add to that position. RSI is remaining above 50. And started to turn up on Friday. We had above average volume, relative volume as well was high, and we're trying to get MACD to turn as a function of price. So if we do see a bullish candle on Monday, Tuesday, look for AMD to attack the highs. It's trending and bullish. Real estate stocks continue to move higher as well, like CB Richard Ellis, flagging, looking like it could test the 9 EMA. If it starts to push higher on Monday, we'll watch for that. Builders are also responding well. We've got DR Horton continuing to move higher. This one was a IBD 50 watch list stock the first 2 weeks of January. That moved higher, did pull back to the 21-day and found buyers. EPRT, also another real estate stock, trending. FISV, a new stock on the IBD 50, trending. Looking very strong. RSI above 50, MACD flat. Looking for MACD to move higher if this does push off of the 21-day this week. Google is also trending off of the 21-day we tested last week. Buyers stepped up, followed through on Wednesday and Thursday. showing relative strength. MACD is about to cross, volume is increasing, and RSI is above 50. Amazon, also a big market mover. Everyone probably knows by now that Bezos sold, I forget, something like $4 or $5 billion worth of shares. Took some profits to help finance the space program. We are seeing a breakout of a big base. So you know the saying, the longer the base, the higher in space. We're breaking above the 2050 zone, closing at 2079 on Friday. Looking for a follow through and a continuation over the next few months. Hiko is back. This was a IBD stock that showed up on the list early in 2018, 2019. Continues to trend and then formed phase 4, the markdown period, phase 1, the base accumulation. Now it's starting to stay above the 9. The 9's above the 21. Volume's increasing. We broke out of a flag last week. Look for this to continue higher, take out 130, then 134, and then ultimately a test of 145 in the next several months, which would equal approximately a 20% gain from these levels, about 24 points on top of this, so right around 150 as RSI continues to point higher. MACD is above the signal line and volume increasing and above average on Friday. L3 Harris Technologies, LHX, breaking out of a consolidation period, just pushing off the 90 MA on Thursday into Friday. RSI showing muscle. The company manufactures aerospace, defense technology, and communications products for the government. Breaking out of the blue zone, that's your buy zone. Nice little cup handle, broke out, consolidated, and now following through. Above average volume, decent earnings, a beat of 28% this last time around. The company is projected to make over $13 per share in 2021. We see an increase of $8.81 to $11.63 forecasted for 2020. That's a 32% increase. All the IBD numbers look good. Looking for L3 Harris to continue to move higher in the weeks ahead, as a cup and handle is a continuation pattern. Look for the depth of the cup as your ultimate target over the next few weeks into the seasonally strongest months of the year. A lot of you are still trading Microsoft. On the daily chart right now, we could see a potential pullback to the 90 MA. I'm watching for any kind of weakness. Volume has been increasing. MACD is almost going vertical. We did have a target of 168, pointed out in this chart that we shared with you back in mid-2019 when we saw this second stage base forming. We were looking for this breakout. Typically with IBD, you look for a 20% gain off of a recent breakout to start taking profits into strength. That gave us a target of 168 on this second stage base. We're looking for a third stage base now. Just know third stage bases do tend to fail more so than a first or a second stage base. So you trade with a smaller position with that in mind. NMI Holdings, NMIH. This one looks like it's going to follow through. Fairly inexpensive name. Looks like it's going to break out as well. Price above the 9 and 21 day. In addition, we're looking for stocks like Paylocity, PCTY, which moved back above the 21 day, closed right at the 9 EMA to follow through this week. Reclaim the 70 zone. RSI and MACD would turn up as a function of price, of course. We'd need to see higher volume. So this isn't as high a probability setup as, say, something like Planet Fitness, which has been a day trade and swing trade setup for months now. Each time it comes back down to the 21 day, we found buyers. Stock followed through, got a bit overextended, hit the upper ATR 3 bands, rejected, came back to the 9 and 21 day. That became another buy. We're looking for the same thing now. It's not pulling back to the 21 day, showing more strength than usual, as you can see with RSI. Most likely Monday will break higher. We'll be interested in taking a trade if it does, using the trade of the day setup for entry. If you entered last week, just keep moving your stops up under Monday's low to start and just continue to trail those along the way. Planet Fitness looks good this week if the markets agree. ResMed, RMD, all of these charts look very similar, as you might note. I love a bullish 9 EMA and 21-day moving average, mainly because this is phase 2 of this particular stock cycle. As we know, phase 2 is the longest cycle. That's the markup period. We continue to see the probability of ResMed moving higher. We'd also look for a small pullback or a flag for entry if you haven't already taken it on the breakout or the pullback here at the 21-day last week. Look for ResMed to continue. Spirit Realty, another stock exhibiting the similar idea. 21-day is trending. The 9 EMA is above. RSI is above 50. We had a recent cup and handle breakout. Continuation pattern is the depth of the cup for your targets. That's about 5 points on top of this, so 57 would be a logical target short term. RSI is rising. MACD is above its signal line. Would love to see more volume on this one. Square, also a nice follow-through trade that we've been taking off of the 9 EMAs. I missed this one last week. I was too busy yapping away during the morning broadcast, but it was on the watch list. It did break higher, has since pulled back on Wednesday to the 9 EMA. Look for a follow-through day on Monday. See if this can't break out above this level overhead. RSI showing muscle, MACD is above its signal line, and volume has been increasing. T. Rowe Price, yet another stock with a rising 9 EMA above its bullish 21-day. Each pull back to the 21-day, showing you the exact same setup, consistent strategy. Buy the pullback once you see a bullish follow-through. Like we had here at 127.43, it held the 21-day. The next day was a bullish day. You could get long a quarter position, half a position, always scaling in. Looking for a follow-through, we got that. And then this past week, following through higher. Look for T. Rowe Price to move higher. One thing about T. Rowe Price, think about it. You've got more people employed. You've got millennials coming out of college, taking their first professional position. One of the first things that corporate clients do is they get you to buy into 401k, which is a wise endeavor. Invest your money, the power of compounding. Anyway, T. Rowe Price is one of those funds that most corporate clients have as one of their investment alternatives. Big cap T. Rowe Price TRBCX. Been investing in T. Rowe Price since the 1990s. When I started really getting involved in 401k and IRA contributions. We can see down here in 2009, we moved from 16 all the way up to 131. A 720% increase, give or take. RSI is rising. This is a testament to long-term investing. And one of the reasons why we don't make a lot of adjustments to our retirement account, we just keep a balanced approach. Okay, traders, that's going to do it for me. This is Cousin Vinny coming to you from theclosingprint.com with your weekend video newsletter. Look at the remaining stocks that I have on the list, relative strength names showing up in the MarketSmith scans, as well as the stocks showing above average volume, in the same vein as stocks that I just pointed out that are trending and moving higher above their 9 and 21-day moving average. I'll send out a watch list later tonight around 11:30, and 8:30 on the West Coast. Look for that in your inbox. Otherwise, have a great weekend. I hope this helps. Take care, and I'll talk to you soon.